The other thing that now we have to talk about, the securitization aspect of it. Securitization in India is a very nascent industry. I mean, those are the numbers that you have for 4 years, the 4 financial years over there. And you can see that mortgage-backed securities, very, very small. That's the red pillar out there, very, very small. There is some securitization. To begin with, it's not very much. These are rupees billions, right? So you have to divide by about 45 in order to get dollar figures, right? So these are not very large numbers that we are talking about, given the size of the economy, given the size of the financial market, right, in India. Secondly, of those, mortgages do not contribute much. Most of the others, if you actually dig into it, are car loans, auto loans, and credit card loans. They are securitized to a much greater extent. Okay. Now, the other thing also is that who are buying it? Remember that the banks in the UK and the US got into trouble because not only were they originators of these loans, right, but along with pension funds and others, they also had them on their balance sheets, on their own balance sheets, right? Now, over here, if you look at it, these are sort of these are again for 3 different, March 31st, as in the UK, is the end of the financial year. So these are end of financial year numbers, right? And you can see most of the investment portfolio. We are not talking credit here. We're talking about the investment part of the portfolio. Most of it is government securities and pretty much vanilla corporate bonds. We're talking about standard debentures and commercial papers and so on and so forth. Very little structured products, if at all, on the bank's balance sheets. Okay, who bought them therefore? Most of them were purchased by mutual funds. Mutual funds were chasing yield. The yield was, and they decided that that is the way to go, right? And mutual funds did get into trouble because of that, but that's another story. That has nothing to do with the banking sector per se, right? So that's where it all remained. There's a very nice article in Business Today about the mutual fund part of it. You can take a look at that. Now, so we have a scenario where money was not cheap, not much of money went into mortgages relative to the real sector, and not much securitization happened. To the extent that it did happen, didn't go on to banks' balance sheets very much. Now, the next part of the story is, so the banks, in a sense, were pretty good, in a pretty good position to begin with. They were not nearly as vulnerable as the ones here or those here or in the US, right? So the next question is, what does state ownership have to do with it? We are talking about regulation over here, right? And part of the story is when you have a largely privately owned banking sector and you regulate it in some ways, you come up with rules and regulations. However, when you have state ownership, de facto, you have some regulation going on over there because you have much greater control over what the banks do, right? If not, even if you have given the banks fair degree of autonomy, as the Indian government has, and in fact many of these public sector banks are listed on the stock exchange and have a fair degree of private ownership in terms of their stock holding, nevertheless the control is in the hand of the government. There's always what central bankers would call moral suasion to go along with that, right? So the question is, what role does it play? The first bit is that if you have 70% of the assets, and you can add up those numbers, and you can see that the State Bank of India and Associates and the nationalized banks together account for over 70% of the assets and deposits. When they control that big a chunk of deposits and assets, there's a reduced likelihood of bank runs. They are state-owned banks. Nobody's going to withdraw money from such a bank, right? The second bit is that even if the assets are somewhat dubious in quality on their balance sheets, if you want to deal with them in the money market, you are not going to question their counterparty risk or how good they are as counterparties, because they are government banks. At the end of the day, they are going to live up to whatever they promise you, right? As a consequence, the likelihood of the money market freezing up on account of uncertainty about asset quality on the bank's balance sheets is very, very low, unlike, say, in the US or the UK case, right? So, in other words, monetary policy, when implemented, is going to work. Okay. The next bit, health of the banks themselves. I deliberately chose these two banks. In the late 90s, the Reserve Bank of India and the government in general identified three banks which were particularly bad in terms of their asset quality and profitability and so on and so forth, right? Now, what advantages do government ownership have? And one of them is that you can recapitalize them. Look at the Tier 1 and Tier 2 capital. Look at the capital adequacy over there, right? And it's very easily done. You are not reliant on the capital markets to do it, right? The second bit is that once again the moral suasion bit comes in, and what these two banks were, these two were part of the three that were identified. What these two banks were forced to do is limit their balance sheet expansion, right? So they were not allowed to go ahead and expand credit hugely. Consequence of that was their NPA to net advances, you can see. The NPA levels are very, very low, right? Because they were there on the balance sheet, but NPAs, as you know, they're written off. And once they're written off, they go off the balance sheet. Because they were not expanding their balance sheets very much, new NPAs were not being created at the same rate. As a consequence, 10 years down the road, this is where they are. Right? So this is one of the consequences of that legacy. That bit of government control essentially enabled the government to and the Reserve Bank together in tandem to clean them up, the banks to a much greater extent. Right? So the banks were in fairly decent shape. Look also at a very important ratio over here, which is the cash to deposit ratio. About 10%, 8 to 10% cash. That's liquidity for the bank. Right? Look at also the fact that 25% of their deposits are in the form of government securities, which is fairly liquid. Right? In the worst possible case, the government can simply buy back their own bonds that they are issued without recourse to anything else. Right? So that's the kind of liquidity that the banks had. Right? Now, what about the maturity of the deposits? This had very little to do with the government itself. Now, if you have to have a bank run, remember that what happened in the UK, starting with Northern Rock, was largely because the government was scared of further bank runs. Right? And they went into HBOS and the others precisely because of that. Right? So first of all, government banks, mostly bank runs are very, very unlikely. Second, they are fairly liquid, even if there were to be a bank run. Third, where would the bank run come from? Look at the structure of most of it is time deposits. You can look at this. These are the figures. So if you look at the numbers going, so